You're watching Master Trader Live, simple market analysis and education to help you make money in the markets. Join us live each week on YouTube and see past episodes at Master Trader Live. And now your show hosts, Greg Capra and Dan Gibby.
Hello, everybody. Welcome back. Wednesday, another episode of Master Trader Live. It'll be a great one. They all are. We think so. So we're going to be talking about preparing for opportunities in bear market bounces. We've seen a few. We got one last week. This one was a bit different. We'll talk about that. But the trend primarily is still down. So until proven otherwise, we assume they are bear market bounces. Why not? We can have many discussions. People have different opinions about whether it is a bear market or not, about just the generic, is it 20% down? Ultimately, is it in a downtrend or not? Is it in a downtrend in multiple time frames? If it is, it's a bear market. And so you can have bear market in the market. There can be bear markets in stocks, even if there isn't in the market. That being said, as long as the trend is down, we'll assume sellers are going to show up until they violate the trend in a major way. So, as you know, we try to keep things pretty simple in our approach, remove the esoteric types of analyses, indicators, and whatever. Keep it simple, stupid method, makes it easier for making trading decisions, and easier is better. Let's do it, Dan.
Good afternoon, welcome. Yeah, obviously very timely subject, Greg, and we, as you know, we decided to put this one together a couple of weeks ago when they started announcing cues in the bear market. We're like, yeah, let's be counter trend and show people how to make money. Stocks move up, down, and sideways, and I don't know the statistic. I wish I Googled it. But I don't know what the average bear market bounce percent is historically, but they can be very vicious and profitable. And that's what our focus is here today. This is our approach, technical base, everything is price, no pattern, no setup, no trade, end of story. Then we take that picture, this picture or others that you see on the time frame that you're trading, and then we take that picture and say, okay, well, where is it in the trend? What about multiple time frames? Are they in agreement? Is that bullish pattern on support or bearish pattern at resistance? Volume can be an enhancer to the bias of the pattern. And what are the broader markets doing? Are you trading with them or something's on its own page? And today we're going to get into market internals a little bit. In fact, we're going to start with that because particularly in bear markets, when we're looking for this technical turn, then we're going to be focused on bottoming patterns and turns and all kinds of bullish patterns that we think are ready to produce a beautiful bounce in a bear market. That's today's session. So Greg, why don't you take this one, because I purposely, I have my answer, but let's see what, which one of these bullish pictures, well, not which one, there's obviously a couple, but are your favorites for setups for bear market bounces? Let's assume the daily chart, of course, because, that's where our pattern's going to come from for the most part for looking for these beautiful counter trend setups into the void.
Well, I don't know about any of them. Primarily, it would be this one.
I was going to say it's going to be a shock pattern. So for me, it's the 180 and it's the W bottom. Exactly. So, right. So we're looking for, in a downtrend, panic. We're looking for what we call the turn or signals of short-term selling exhaustion. And we're wanting kind of a shock component with it. It could be a gap also, actually, if something's basing and then gap breakout. But it's definitely not this one by definition. And the reason I say that is because a master trader buy setup is a controlled pullback in an uptrend. So it's not that one. Red bar ignored, it's a continuation pattern. I'm really not interested in much as a continuation as I am the shock pattern at the low. So we got plenty.
To add to that would be range expansion bars. So with any kind of extreme move, which is associated with fear and greed. So when we talk about bear markets, it's all about fear. People are losing money. They're in hope mode. And at some point, they throw in the towel and we get a range expansion bar. So there's two points to make here. So like this pattern right here could be, it depends on what preceded it, meaning if it was going sideways, it could be that.
Of course, right? It's a derivative of this.
Right. So it depends on whether it's going up or down, what preceded it, whereas that pattern in an uptrend, a bullish trend, would be a great pattern. But looking for that shock element to it, in addition to this range expansion where it got emotional, where it breaks to the downside, and it looks like, oh my God, think about what happened during the stabilization. So one of the useful tools, if you will, is to put yourself in the pattern, even if you're not in it, because we like students to understand the psychology behind the pattern. And so you have to feel it. And once your money is there and you're losing, of course, it intensifies the feeling. But if prices have been going down and they're going sideways for a period of time, think about what does that create for you if you were in it? Hope it's going to bounce. I'm going to get some of my money back. Maybe this is going to be the rally. And then it snaps to the downside and you're like, that's it. Done, right? Hit the button. This thing's a piece of crap. It's going lower.
Right.
Lo and behold, it snaps right back up again. It was just waiting for you to do it, it seems. But that's why patterns relate to psychology, and understanding that helps. And I know it helps me have confidence in a trade when I see that kind of a situation. In addition to those that are long and in pain, you have traders naturally looking to profit for that bearish trend and going down. So they hit the button, they short the breakdown. It looks like it's going to go lower. Maybe they're not aware that it closed the void, that there's support over here somewhere, and it snaps back up again. So that supply that came in, driving it lower, now becomes demand. Why? What are you going to do if you shorted that and it snapped back up again? Cover, right? It didn't work, move on, whatever. And that can start some kind of counter trend rally. So range expansion bars, right? Telling, part of shakeouts and, basically throwing in the towel, so to speak. The shakeout related to I shorted it and it snapped back in my face. Throwing in the towel, I thought it was going to stabilize, but it went down and I just hit the bid and got out. And then it went back up again.
Couple words here. So, bear market, textbook, that's what they'll teach you in school, a steep and sustained market downturn, just 20% or more market drop from the highs. And it's going to get to that because things are deteriorating. So, that's a fundamental type of thing. Are you in a recession? That's on the news every day. Or what are the probabilities of recession? Greg's a master at looking at yield curves, which are excellent indicators of an upcoming recession. People are pessimistic, they're losing money. So we have negative sentiment and breadth. We're going to cover that next, of what that means and the levels that we want to see for these beautiful bounces. You know, things get sold into, they can be very profitable. So what do you do in a bear market? I just threw a couple of options here. Some people, as we all know, they're just keep, every time it's down 5%, just keep buying more. I can't argue with that. That's fine, but our approach is better because, Greg, you heard me say in the green trading room the other day that I got an email where, you know, this new subscriber is, I'm getting my head chopped off this year, and you know, can you all help me? And I'm like, I trade 3 accounts and I'm a beautifully profitable. So that's this third one. We trade and invest using our approach. So my point is, I personally don't believe in just, I'm down X%, buy more. As you know, both of us, we need a pattern and a reason and a high probability setup to engage. A third option, move to cash. Do you remember, Greg, in the any bear market, but in particular the internet crash? Do you remember all money managers were, oh, well, the S&P was down 33% and I'm only down 28%. And that's how they were comparing their performance is less worse than the benchmark. So
sure.
So moving to cash is an acceptable you know, strategy, but then you have to have an approach to get back in, or else you can miss the upsides.
Well, they don't, most of them have too much money to move, to go total to cash and get back in again. So it's very difficult for them. So there's always, you know, hedging that they'll do to potentially limit their losses. But a lot of money managers aren't so much into timing. Basically, they don't have a method for timing. You know, so a lot of them, of course, just bear with the bear market. And like you say, you know, their claim to fame is, well, I didn't lose as much as the other guy.
Right.
And so it's hard. The more money you manage, the more difficult it becomes.
Sure.
You know, to move it around like that.
But as you know, with the S&P futures market and options on futures, you know, we're always looking at that JPM hedge that they have a fund, whatever.
Yeah.
I don't care how much money you have. If they had you and me on their team, man, we could smack a 1,000 contracts of at the money calls to hedge. But you know, I'm getting off subject. Couple more points here. You know, we're pattern traders, multiple time frames, and then we're looking for these turning points. So that's just a 1-sentence summary of what we're looking for. So now let's talk a little bit about these market internals. You know, Greg, why don't I just go right to this and let you comment on sentiment and breadth.
Let me see what you had on the prior one.
It's just a definition, so you can say it.
Right, so the sentiment part, there's lots of different ways of measuring sentiment.
So here,
but you know, an estimate, you know, so one of the ways, other than what you're looking at here, there's that AAII sentiment reading where investors say whether they're bullish or bearish. That's something that can be tracked. There's some historical measures. I think like if too many are by 60% they're bullish or bearish, that's, you know, some historical turning points. There is information that tracks newsletter writers or investment advisors. That's something that I tracked years ago. I tracked all of those things years ago. And it's like here you have all these different measurements that are, how do individuals feel about the market? All right. Newsletter writer, investment advisor, investor, trader, yada, yada, yada. It became redundant, right? So I'm sharing that with you because maybe those are things that you're hearing about or considering. So they became redundant. And then there's breadth. There's different breadth market internals. Advanced decline lines, I found those to be essentially useless. They didn't lead, they lagged too much, or didn't even help at all. There are different ways of massaging new highs and new lows, and advancing volume and declining volume, advancers and decliners. And so I settled on this McClellan oscillator. Went back and looked at decades of information as to when it was at an extreme. Did it actually mark highs and lows? Sometimes, but it wasn't really that consistent. It wasn't that good, but it was good. Now, what is a McClellan oscillator? All it is, it's so simple. It's like, if you know what a MACD indicator is, it measures the difference between two moving averages. So it looks at advancers minus decliners, right? That raw data, and it plots a 19 exponential period moving average and a 39 period exponential moving average. And then it measures the difference. So what this line is doing here, right, this line that's moving up and down, there's two moving averages, right, just like any other moving averages. And the distance between them is where this value is. If the 19 is above the 39, it's above zero. If the 19 is below the 39, it's below zero. It's really simple. Now, the further it gets apart from each other, coming down into this area, the distance between the moving averages considered an extreme. Okay, breadth has gotten extremely bearish historically to where it's likely it's going to bounce. Okay, great. Well, you know what? What about all those times it didn't work? Sentiment, total put call ratio, total put call ratio, all right? There's equity put call ratio, tended to be redundant, somewhat useful. There's an index put call ratio, was totally useless. And so there's different put call ratios on different sectors and so on that could be looked at, but it all becomes overwhelming. The key was when sentiment matched with breadth, it worked like a charm. It was great. So things got to an extreme, right? They moved up too much, it was too good. And option traders were betting the farm, so to speak, right? Too many calls versus put options. It's a ratio and a measurement. So the static measurement historically that worked well was 0.80 and down here 1.2. This is an old chart, a more bullish market environment, but static was here at 1.2. Right? Can the McClellan oscillator be used for individual stocks? No, you wouldn't do that. You could put a MACD indicator on it, which is just telling you the difference between two moving averages. So you could just look at the moving averages. But that's what a MACD indicator does. It looks at the difference between two moving averages. If your software could have had the ability to do it, you could create a group of your own stocks and create a McClellan oscillator to it, right? The difference between two moving averages. So what are these bands up here, right? So what I found was that in a bull market, it didn't get, there's this inverted, I actually have this inverted, but let's just go with this here now. In a bull market, it didn't get to a bearish extreme as it does in a real bear market. So I created these bands, and I'll just give you the short here. You can create it. We don't have the proprietary stuff. This is a 5-period moving average of the raw data, total put call ratio. These bands, what I did was I applied a 100 MA to this 5 MA. So now it smoothed that out. And then I put a 10% envelope and a 20% envelope above and below that 100 MA. And it created these bands. So the bands adjust the levels for bull markets and bear markets, and it works really well. So the short of all that is when they both match bearishly, look out for tops. And when they both match where they've gotten too bearish, look for bottoms.
Greg, I'm just noticing this. Why don't you have a bands on the green one here on sentiment?
It is that this is the 10% band and this is the 20% band.
Okay, I thought the solid green was related to this solid red.
No, this is 20%,
Okay.
10%. So now this horizontal line at 0.80 is the static level. Now, if this chart was bigger, expanded more, we had an example, you'd see a green line going down here at 1.2.
Okay, so that's what I can't see. Got it.
So two pieces of information. Have stocks moved too far too fast? And are option traders overly bullish or overly bearish? Sentiment and breadth in agreement.
I should just continue that discussion. And this was actually the first coronavirus shellacking before we got that bear market bounce. And just continue your discussion here, Greg, that I don't want to speak for you, but I had never seen these two at this extremes. And the VIX actually made a higher high than it did in the 2008 financial crisis. So we were so incredibly bullish at the time once we found a turn for a bear market bounce. It wasn't the low. The low was made March the following year, the corona low. But we were bullish as can be based on this picture.
So when this goes like that, from an extreme high point to an extreme low point, it indicates power and it should be respected. Typically, while you might get a bounce, there'll often be a retest where prices make a lower low and this will make a higher low. There'll be some relative strength. Now, this is a bear market. Obviously this was, but Corona was different than, that was a spike low based on this pandemic thing that everybody was going to die. I thought, I was going to walk out my door and dead people were all over the place, but it was a bit of a farce in a sense, I think. But in any event, then there was this massive influx of liquidity to fuel the markets and make them, move up, which it did, of course. So these bands have to now catch up. And what we see is they begin to roll over and they adjust to lower levels to where when this bounces up, it may get to 0.8. So it compensates. And in a bullish market environment, when this actually started to go up, these bands then began to swing up. And so the extremes on the downside became higher. So it compensates for bullish and bearish markets. But the idea is when they're in agreement, historically, the odds are the market is at a turning point.
VIX is a volatility index, and we use this both for swing trading and for these bear market bounces because we're looking. So what the volatility index is the implied volatility out of the money calls and puts on the SPX, and it shows us during market sell-offs, volatility, CBOE volatility index is rising because people are fearful. So they're buying put options or they're buying puts to hedge existing positions. So it's kind of in the same ballpark of sentiment that Greg talked about, but it's just a third one where we're looking for big spikes, and everything we do is not, okay, I'm following Greg's slide here of they're at a bullish extreme, let me go buy. The market internal signal is get ready, get ready, get ready. The action point is a reversal bar. One more market internal here, Greg, and then we'll start looking at some charts. This was last week that you put in the weekend letter, and it's just a daily microscope of the breadth turn that we did trade. So this was kind of a big W bottom. It's the bear market bounce that we're in right now, other than today's pullback. And, you take it from there.
I understand Kevin's talking about the vaccine. It's another conversation, but I think that vaccine has killed a lot of people. I know it killed a couple of my friends that seemed to be fine and mysterious illnesses. Anyway, this is just looking at day-to-day breadth. So two things, and this could be utilized at the end of the day. So what happened with this last rally, you can see here where the move started, it broke down and then this retested. And this came up to that plus 2,000, which is what you want to see on a rally. Now, typically, they don't just fall apart like this. Market environments change, and this had just broken down. And you can see the moving averages were pointing down 20, pointing down 20 under the 50, 50 pointing down and under the 200. So multiple time frames pointing lower. Excuse me. But what I wrote in the newsletter here a couple of weeks ago was that, look, if this does come off of this low here, we want to see this AD line close above 2,000. The more above 2,000, the better. And it did that. It got up here almost to 2,300, which showed, hey, there was an extreme amount of stocks that were advancing during that move up, giving confirmation, whereas, on this one, it wasn't very good at all, right? And then as it came down and it went down to, an extreme here, it just gives you a measure of what has happened on that particular day and what might happen. So when it does get to the extreme like that, you know what, there was power, but it's likely to stall. And that's what we see happening right now. It's stalled. Now, based on this, it shouldn't come all the way back down here. And that would be kind of a little crazy if it did that, because historically it doesn't after such an extreme.
Well, and particularly with a weekly pattern like this. Yeah.
All right. So let's move this up. Pictures are up there. So what we look for, this is in a bear market. Right? We know that if we saw this whole thing, there's a big topping pattern here. And so this just moved down a whole bunch and we got a wide range bar. So we look, okay, this should be able to bounce higher. Will it retrace into here? It certainly could, but eventually it's going to run into a whole bunch of sellers up here because it's in a bear market. And just like we look for, divergences between buying and selling pressure, right? So where this got to an extreme and showed strength, we may get a move up like that. And this is going to make a lower high, telling us that there were now fewer stocks participating. And we'll look at what stock, and then we look at individual stocks and markets. This just gives us a broad picture bias of what's going on. And then we look under the hood and go to, different sectors. So what are the semiconductors doing, retailers doing, healthcare, so on. And then we can look at individual stocks, but it just gives us, that the market is, the market, the big picture of it. And then we can start zeroing down to say, hey, what didn't participate like this? Or what participated even better than this? But this tells us, hey, you know what? Something changed here from what was going on here. Gives us a clear, objective measurement, not our opinions. And it's really simple. It's available to everybody, nothing proprietary again.
Yep. And so this was last week's bear market bounce that we were looking for. We were looking for the turn on this weekly climactic buy setup, still on a downtrend, but we're traders and we want to make money on these bounces. So this was our double bottom, breakdown failure, bottoming tail, sideways, another bottoming tail. And we started getting bullish last Wednesday, and this is Thursday, Friday. Now we're extended, we're waiting for pullback, which is what we're getting now. And as always, we'll show you, we'll go to the charts and look at things in real time. This is just talking about, okay, the turn. So let's just go right to examples. And, Greg talked about, range expansion on the turn. This is a chart that just shows you, and you got to flip it upside down, obviously, but pretend we're down all these amount of red bars. Well, Greg, you say it doesn't have it, but you have a page on your market internals that has it. I thought you had it. So
What's that, Dan?
the whatever Sam was asking for. All right.
No, an e-signal that has it. TC2000 doesn't have that raw data. I don't think so.
So this is just showing you different pictures of the potency of the turn. Again, flip it upside down, and this is going to be one of the strategies for our pictures of turn for a bear market bounce. Got a bunch of different flavors here. They're going to be in different trends. So this particular stock, look, this is the first thing that grabs my eye. The concept of breakdown failure, no follow through to this ugly red bar in a downtrend. It doesn't mean I'm doing anything. It's an observation. And then I'm looking for a setup with our other concepts. Moved up, came down. Here was another little small breakdown failure, gapped up. It's actually Apple. I remember this stuff. And then we bought over the high of this red bar with a big price void. And Apple, today's high was 151. And it all started from this pattern right here.
That's a current chart, Dan?
I think that's a year ago, actually, a year ago bottom. But it went much higher than that. Apple went to almost 180. So now it's back to 148 from 180. But last year, this was the beautiful bottoming pattern that we got into Apple. But, it's the same concept. It's trading, a huge retracement. And this one is a bottoming pattern.
Yeah. So one of the things, so these are older charts, and point being, it wasn't the start of a bear market yet. So one of the things I want to point out is that, because we're looking at patterns now, and one of the reasons that we look for range expansion bars near the end is that in a bear market, and I believe that not that it wasn't this way years ago, but I believe that technology has advanced the ability of whether it's market makers or hedge funds or whatever. I mean, in essence, they really don't need market makers anymore, because these algos have become so sophisticated that they can give out the shares in such a way that it's so systematic that you see the bars become very controlled, and like it declines and declines, and the bars are about the same size. And then near the end, you get the range expansion bar. So while it's moving down in such a controlled manner, it's very systematic selling. And so you don't want to be buying those dips. You want to wait for the range expansion and then reversal and possibly a retest. The retest is even better. But when they're really selling in a very systematic way, you'll see it. Sometimes Dan and I refer to them as death trends.
Exactly right. Exactly right. So another kind of just different bottoming pattern here, but I'm
But-
showing you this
but
one.
Look at these bars and then look at what happened here. So while this was the beginning, right? This was this, down, 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 and beginning of the turn, and then, created this support. And this is the first slide we looked at where it broke down. It doesn't look exactly like that, but it's the same idea. It broke down under these lows and it sprung back up again, and you've got a range expansion bar. That's a powerful turn.
Right, right. And, look at the price of the stock. It's a penny stock, 24 cents. And so our approach is the same. It doesn't matter. Put tape over the price. That's a very bullish turn right there, as you said. So is this in a bear market? Well, yes, if you use our definition, this is off 20% off the high. This was Sun W. And so that's weekly chart going sideways. Downtrend here. It's finally closing, breakout, big bottoming pattern. The 20 MA is curling, and we have a bullish weekly stabilization with a price wick. So
again, that measurement that the media gives of 20% is very misleading, because that is not a bear market, even though it's down 20%, because it did not violate major support.
well, that's an excellent point. So
So as this came down and was making this kind of bottoming action with a weekly chart that's in an uptrend, that is what you look for within a correction within a bull market.
and this thing, because it got climactic,
It created a void and it came down a lot.
Right. So point well taken. This could be more of, a bottoming pattern, how to get on board something that went parabolic. And now I got my beautiful entry.
So what really, and one of the reasons I started calling this a bear market long before it got to near 20%, was you look at the indices and you don't have this and pullbacks with moving averages like that. You have rounding tops with the moving averages rolling over the top of it. So you had this relatively long period of distribution that was going on, and then breaking down, which was so different than what we're experiencing from the pandemic low. And the pandemic wasn't even, while it was a measure of a big correction, it happened and it was over, right? A V type of a bottom. Whereas a real bear market, just go back and look at the charts after March of 2000 and you'll see a real bear market.
Yeah.
Horrendous bear market.
Yeah, I think, all right, yeah, we can go through these quicker. I think we'll be better looking at at some real charts here. Another type of bottoming pattern, went sideways, got above the 20. Here's our live trading room, which we do every market day, obviously, starting at 9 a.m. Greg does pre-market analysis, sectors, internals, everything. We look at our opens, our hit list, our gap trades, and throughout the day, it's live education. So instead of talking about a nice PowerPoint slide, we're doing our analysis in real time, answering questions, scanning, looking for opportunities. So it's a fantastic place to come get to know us. This thing down, look at this thing got cut in half, going sideways, small breakdown failure, red bar ignored, green bar, little small 180 reversal. I don't care what this is. That is your point to get, and look at the volume I said was secondary, but the increasing volume on this green bar makes this little reversal at the 200 more powerful than it were without that. Would we still trade it without the volume? Yes, but that's an additive. This one is one we did trade the other day, or other last month. What we call a bear sandwich. It's in a nasty downtrend, had two big green bars negating. So we have that shock pattern after going sideways. Greg talked about this range expansion after a big sell-off. So just because you have a big range expansion doesn't mean anything yet. It means start paying attention. So it's down a lot, range expansion on a prior low. Look at that. That's kind of the puking volume. And then it goes sideways for 2 weeks with red bar ignoring the price void. That's our entry over the red bar's high.
So I posted a link in there because someone in YouTube asked about internals and settings and whatever. So that link provides you with the breadth internal, the chart on the left. Disregard the moving averages. You just want to see the levels that I showed, plus and minus 100. The VIX, you can just see is going up and down. You look at prior highs and lows. And then that $ PCP, again, that's the raw data, the line, remove the moving averages, and just put a 5 MA on there, and you'll see the same thing that was shown in one of the slides. Now, you could put the bands. I don't subscribe to that website, but they do have that information there, and it's free. Just save that URL, and you can look at those internals at any time at a glance. So something that's free, you can look at them until you figure out if you have a platform that you can put them on your own platform.
So this WST is one that, Greg, you mentioned in last weekend's letter. So, that's an ugly fall. When are we interested? Went up, okay, it's a 180 reversal, then going sideways for another week. So the selling has eased. Supply and demand are agreeing on these valuation levels. Here's a little gap, closing breakout. So this would be a buy over the high of this. I'm looking at it right now, 2 days later, and it didn't take out the high. It's retracing here with the market for the next 2 days. But if it were to take out the high, then this is what we call a price void, which is insignificant resistance to the left. This thing, I have no idea. It might go to 340, this 50 MA right here, but that's one on our watch list. I don't know what this is. It's just ugly gap, multi-month gap breakout, bullish close, price void. So they come in all different flavors. This one we did recently, Qualcomm, red bars ignored. So Greg, these three right here are on the 9 bullish patterns slide where we say, call it what you want, it's going up. So this was a 3-bar reversal. Red bar, little bar, back up to the high.
Yeah.
So
just, we have a lot of people that come to all the MT lives, but there's always new people. So I just want to mention that, because look, our whole approach here is a goal to help all of you and to demystify this thing called technical analysis. And candlesticks, while great visual representations of what's happening, the gurus out there really confuse the crap out of all of you, because they have all of these names and you get hung up on these names, morning stars and dark cloud coverage and piercing patterns and haram eyes. Oh my God. In reality, it went down and it went back up again. Just because that one stalled in between the 2 bars doesn't mean a damn thing. If we were to compress the data, it could be a bottoming tail bar. So what you want to recognize is that it went down a pretty large amount and it came right back up again. And you put it in the context of what preceded it and the trend, and it's valuable information.
all right, so I think we're ready to look at real charts here. This is this is Greg's amazing swing trading course. Puts all he calls them thought building modules. So at the end of the course, you have the information to objectively interpret and trade anything that moves, even that penny stock we showed you earlier on. It has trade management, trader psychology, so much more in there. I don't care what level of technical expertise you currently have, this course just catapults your understanding of it. And so, Greg, I don't know if you want to tell them about we got a special coming out soon.
They'll get the email.
Yeah. All right. So let's look at some real charts here and see if we can find some. We're pulling in now. Greg will show you on the broader markets, but we'll still be looking for the next bear market bounce. So let's apply what we learned today. We can show again the bounce that we entered last week and what's going on right now. So yeah, Nicole, I just looked at those two oils, and yeah, the continuation patterns, we sandwich any continuation pattern. We don't want them that extended, and that ESTE is really far from the 20. I did find one in the oil patch though. No, that's not it. I don't know. I did find a nice one earlier. I forget the symbol.
Stefan, the swing trading course doesn't cover intraday. It doesn't go to the extent of the money management that it does in the MTS course. There's just a lot more detail in the MTS course. But the swing trading course is swing trading, daily charts, weekly charts. There's some monthly in there. I do cover, some intermarket analysis and market internals related to, there'll be what we covered today about market internals. It doesn't cover intraday market internals because it's a swing trading course. So there's a lot more information in MTS, which was on special. A bunch of people took advantage of that. It's like 50% off. If you're interested in the MTS course, I don't think that coupon code works anymore. Maybe it does, but if you're interested, email me. But the swing trading course, you can see that it's like half price if you get it with MTS. It's a great deal. But we're going to have a special coming out on all courses this month. Just the email hasn't sent yet.
So the Qs, I think, hit almost 30% down. That the spiders there at that bottoming tail low, I think, was just a tad away from the 20% bear market calculation.
So let's go with some higher time frames here, and you can see how this was going up in the past. Let me get this thing. Here's the pandemic, the little mini crash, and then right back up again is how it was advancing, and all continued to advance. And now we have this situation where this rounding or head and shoulders kind of a top there. So we didn't have to get down 20% or 30%, whatever, for us to call it a bear market. It went sideways there for almost a year, and then it broke down. And then we start looking to the left and see, where is there some type of significant support, which was down here in this area there where it bounced from. So it's always an area that we're looking at, rarely ever an exact point, but these pivots, right, which is just marks three higher low bars to the left and right, and we call it a pivot because there was some kind of retracement and then back up again. So kind of like a pivot point, right? And then a retest, two pivot points create a larger area of support, whereas these were single areas there. And on the way down, and this just got a little extended. Now, it doesn't mean that this downtrend is over. I don't think I can go back to 1999. I guess I could on a monthly chart. It's so long ago. You can see the similarity of the topping pattern there, as opposed to, these rollovers. And so this came down quite a bit, but this was a bear market that took this down about 90%.
Yeah.
And then years of sideways price action. So in topping pattern, ideally we'd get some kind of a retest pattern. We look at our market internals to measure what's happening at that time. And looking at the diamonds, higher time frame, big rounding top. So I think this should come down. It's in a downtrend, so it should come down and retest this. We'll see what kind of bottoming price action it might be able to form. And we got the Dow, we got the S&P, right? Same topping pattern. So when you get these big advances, it's going to take time to begin to rebuild again. And usually bear markets take longer to build out bases because there's so many more people that just need to get out. So it bottoms out for a while before that happens. Looking at just what's happening today, you see it's been going down for a while, daily chart here. This is where we had last week this advance. So what we're looking for here, right? Dan and I do pre-market review every day from 9 to 9:30 on YouTube. You can go in there on YouTube and listen. So one of the things I said this morning, even yesterday, was we're looking for a correction bar pattern. We'll see if it happens. So this could either turn into a bottoming tail bar today, which we still have several hours. It could happen, or what we need to see tomorrow would be a reversal. And then we'd look for that bounce, wherever it's going to take it within this upward move. Now, in this platform, it doesn't have put call ratios, but you can see this breadth internal, how it spiked up so much higher than what it was a broad market participation. And many times what we see happen is that this pulls back toward the zero line, which is historically a good measure to look for the turn to start to happen. So I don't know if it gets there today, that means there's more selling going to happen in the afternoon, but maybe it'll happen tomorrow. Charles, no, you don't have to subscribe to YouTube. So if you just type youtube.com/C/Master Trader, it'll take you to the channel. And there's lots of good videos there. Dan's done tons of them on options. I've done others on candles and, different things. So you can go and check that out. Lots of great information there. And by the way, when you join Master Trader, I'll show you something else. Like this has got all these scans in here, wide range bars. Remember how many wide range bars there were?
Last week.
On the rally day?
Yep.
There's like several hundred of them.
Right.
Right. Today there's 4. Means that like the market's dead. But the bearish ones, look, 679 bearish wide range bars. That in itself tells you what kind of day it is. Then, you can sort these and show me the ones with the greatest amount of volume. So there's lots of patterns like this that had this advance last week, and it's making this turn. So we're going to see how far, because how this advanced last week, this really shouldn't go back down to the low. That's why we're looking for a continuation pattern, right? But we'll see. In advance, it got above that resistance area, come into the next. So there's a lot of red bars today. We'll see if they turn around or whether we get a turn tomorrow or the next day, because look, institutions were buying hand over the fist on Thursday and Friday. How do I know that without talking to them? The market internal gauge tells me, because this went up so much higher. You have to go back over here. Right? Go back over here. Go back to the pandemic low where they were buying hand over fist. Over here, they were buying dips, which was all fine. It was in an uptrend. And here we had some extensive selling on the downside, which you can see lining up with that spider chart. Look at that one there. See, these are part of the tells that you get from the internals, where this internal gauge went down there and spiked lower than any of these lows. Look at where the S&P was here. It was still in an uptrend, but there was so much negative breath on that day. It was like a heads up, something's wrong. Even though this is in an uptrend, why is there such tremendous selling? And then over here, well, now it's obvious, right? It just breaks down and crashes. So yeah, that is what it's supposed to do. And then, you know, he had this advance. And so you just learn to read these tea leaves, so to speak. And now we've had this big spike up. So they're buying again hand over fist. And it took out this high. Can we get a continuation pattern, which is still in the context of this bear market downtrend? So we'll just need to see how much that this can move up or not. If this comes back down into this area, maybe it's just a larger bottoming process. In reality, we have this information, and now it leads us to thinking continuation pattern. The deeper it retraces down to here, the more that becomes into question. So it's not like we know the future, nobody does, but we know what happened in the moment and historically what should happen. Now we'll see what unfolds. If we get a red bar ignored, or what we call a bullish 180 reversal tomorrow, it's going to be black and white that we should be buyers.
To the 50 MA at least, yep.
And it shouldn't break down below that low. So that's what we're waiting for, right? And if it closes this way today, does it actually follow through? Do we get a green bar tomorrow? So we have these different measurements of breadth and sentiment. We have, is the trend going up, down, or sideways? We have different candle patterns that we put in the context of the location and what preceded them. So it all comes together with a systematic approach that we call Master Trader Technical Strategies. And so as you look at that, your job is to now apply that. And in a sense, look, we're all part of reading this thing here, but the goal of the whole method here is to force us to apply the method and not what we want, right? So I may want this to go up, but maybe it'll keep going down. But I've got information to support that it should go up within the context of a bear market. But I have to continually apply this information. Otherwise, I start pressing the button in what we call, what do we call that?
You're watching Master Trader.
One button there. Impulse trades. So through the courses is what we call the fast track to assimilating this information. And of course, in the green room, we talk about it. And you can come in there and ask Dan questions and me questions. And, you know, besides looking for trades, we're educating every day, all day long.
Thank you for listening to Master Trader
See you
Live.
next week.
If If you liked the show, we invite you to share this video on your timeline or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the channel and press the bell to get alerts. If you've enjoyed the event, please give us a thumbs up. Just visit mastertrader.com. That's mastertrader.com.